Hi, everyone. Welcome to the debt panel topic today, or discussion with our esteemed colleagues, really covering quite a broad range of geographies across Europe. Apologies, you'll have to bear with me because I've sort of lost my voice in the course of the IHIF. Having said that, I think debt is certainly a very relevant topic, particularly as hotel owners and or operators, and there's quite a broad range of different types of hotels, from the trophy through the resort, urban, as well as regional. And given a lot of the pickup in activity, it's been an asset class that a lot of lenders who have expertise in it have been leading the charge, and other lenders who want to really gain exposure to the sector have begun to sort of delve in and come into the frame. I think with that said, let's sort of get started here. And I think the idea very simply is to have an interactive discussion with everyone in the audience. So you should feel free to raise your hand if you have questions throughout. But importantly, covering really a broad perspective or range of topics between underwriting from a lender's perspective. What are the types of things they're looking for when various business plans are being presented to them? Oftentimes, lenders will be looking at the same asset that's being competitively bid by a number of different groups with a number of different business plans. And so, they're getting quite an interesting perspective in terms of how many different institutions are approaching potential acquisitions. At the same time, looking a little bit at really the broad range of hotels, what's the general appetite amongst the friends that are sitting on the panel here between trophy, urban, regional? How do they think about different gateway cities across Europe, without maybe getting into specifics around pricing, but certainly, are there any deltas in the underwriting standards? What are they actually looking for? And then, breaking into more specifics around, and, again, keeping it high level, but looking at what is the lender appetite for transitional versus ramp up versus refurb versus stabilized development, leased, managed, or franchise. Is there a difference for the lenders? And then maybe, provide or allow everyone on the panel here to provide a little bit of perspective around, their home markets, as well as looking at maybe some of the lessons that they learned from the last cycle. So with that said, I'd like to start with Desmond to the left here, and maybe you can introduce yourself.
I imagine I'm here as a positive irritant, as the only non-lender on this panel to cast comment and nasturtiums on any opinions given, and general differences between lenders, how they're evaluating projects, because it'll be interesting, hopefully, for the banks to see how, as a borrower, we sift and analyse their feedback on certain lending arrangements. So hopefully that will give a bit of a customer-focused perspective.
Right. You want
me
to introduce myself?
Oh, am I introducing people?
No, just
okay. Well, good afternoon, everybody.
Not over-rehearsed.
Not over-rehearsed at all. No, Desmond. Well, good afternoon, everybody. My name is Bob Silk. I'm with Barclays Bank Hotels team, where I've been involved with lending into the hotel industry for the past 18 years. Our practice is a largely UK-centric business. So, over to you.
Thank you very much. My name is Ernst Heckmann. I'm Client Relationship Manager for PBB, Deutsche Pfandbriefbank. And we see ourselves as a European bank. And I guess you heard about our privatization last year, and we are happy to lend to hotels as well again. And happy to continue with the panel discussion.
Yeah. Good afternoon. My name is Lorenzo Vianello. I work in UniCredit. I do cover real estate and international hotel chains in Italy. And for this event, I collected also what's the perspective from my colleagues in CE area, Germany and Austria, so to provide with a few ideas about real estate lending in hospitality.
Good afternoon. I'm Arnaud Levacher from Crédit Agricole. I am based in London, part of the origination team, part of the real estate and lodging department. So we tend to focus on anything which is in London and the region. And we've got a presence in Europe, in Spain, Italy, France, which are the main countries where we're active.
Perfect. So I think with our esteemed panelists, we should really sort of dig in. And I'd say, from starting at the sort of foundation level, when you're looking at underwriting, just generally speaking around hotels, what are the key metrics that you're focused on? Is it LTV, cash flow? How are you buying into the ramp up or the improvement of overall revenue and EBITDA and NOI across the board? Again, just sort of high level, big picture.
Okay, so shall I take that first? Okay, so I guess the key thing that we're focused upon in lending to a hotel business, or any business for that matter, is actually management's ability to generate a sustainable level of cash flow that's sufficient to support all of the business's outgoings plus a margin of safety. And that's fundamental to anything that you do, whether you're a lender or an equity investor. And I think within what I've just said, that the key thing, the key word is about cash flow. And so it's interesting, in the lead up to 2007, when the world came to an end, increasingly the lending community became more and more focused upon loan-to-value driven lending, which is actually, in my view, quite a flawed approach, because the capital value of these assets is a capitalisation of their cash flow. So all roads lead back to cash. And if you think about the house or the flat that you own, it's your monthly net disposable income, the cash that you've got that services the mortgage, not the value of the property. So our particular focus is very much upon cash and ensuring that we don't lend beyond the business's ability to service its debt. And LTV, although that is often the starting point for a discussion with a borrower would typically say, okay, well, what will you provide me in terms of LTV? We would always tend to steer the conversation toward sustainable cash flow. So.
Yeah, cash is always like the most important point, I guess, for a bank, that they see a real estate is producing cash and cash flow. The question behind is, for us as a bank, of course, we think, okay, where is the safest cash flow? And I guess maybe there are some differences between the banks, like what we are focusing and what we learned out of the crisis of 2009 as well, is that we want to focus on very good locations, on quality assets, on very good partners. And then it doesn't depend so much on the structure, if it's now a lease contract, if it's a management contract, if it's a franchise contract. But if we have a really good product and in a very good location, then somehow we feel safe. Of course, you model then your cash flow and you look at the safety that you have in your cash flow, like at what level of RevPAR there's no possibility anymore to service the lease or to service the debt service. Yeah, and this is I guess the most important underwriting what we are doing when we are looking at the hotel.
Does that mean when you look at valuations that then you really look at the cash flow projections, or you turn to page 27 and check out the valuation and move on? Because we have this debate with lenders and valuers that you agree what your target LTV is, and we all agree fundamentally cash flow, but this is an observation rather than necessarily an opinion, that a lot of the valuation reports that are critical condition precedent to drawdown or closing of the loan still seem to focus on valuation. And I don't know if you have an impression whether your industry has put pressure or influence on the valuers, the wrong word, the consultants providing the lending comfort to change the balance. I mean, I've not seen it. I'm interested whether you folks have seen that evolve over the 07 to 16.
It's changed. So prior to '07, as I said earlier, it was mainly LTV driven. We get the major financial crash, and there's this flight toward cash. And now we're coming out of the other end of that some years ago, and once again, a lot of the competition that we see are loan-to-value driven lenders. So the circle has turned, and it will turn again.
Someone invented a statistic that all the lending in 2015, I think it might have been the UK, less than 40% of that was traditional banks. And that 30% were pension funds and insurance companies and 30% others, which are the new entrants to the market. Do you think those others then are coming in on different metrics? I wouldn't say less sophisticated because that's opinionated. But do you think they're coming in on a less sophisticated measure of metrics and lending criteria?
I think the funds and alternative lenders, they have a different view from a traditional sort of, high street bank. High street banks tend to be focused upon, okay, I'll lend you X million of pounds, but I actually want to get my money back commencing 3 months after I've lent the money. Whereas a fund is simply looking for yield, and as a consequence of that, they'll extend over a far longer tenor, 7, 10, maybe even 15 years, and just take a loan-to-value approach and be quite happy just to take yield and not be interested in capital repayment.
So is that, back to that valuation point then, are you getting of 100 pages, 90 discussing cash flow and 10 value, or which is what I would have hoped that would have moved towards, or still value is still the gate or determinant of advance?
Okay, well, I don't think that 90 pages are discussing cash flow, but it's certainly a fair amount discussing cash flow. And for us, that's our primary focus, is upon cash flow. Certainly don't turn to the back of the valuation and say, okay, what's it worth? Okay, we can lend X% of that, and off you go. That's not the way that certainly at Barclays, that we approach things.
Yeah, for us, certainly, like the LTV is one important criteria, like especially day one when it comes to loan sizing, but in my opinion, the cash flow shouldn't be so much different from like the biggest influence on the value is the cash flow. So there should be not so much difference between these two measures. And the higher the loan to value we are lending, then the more difficult it is as well to show like that our debt service can be paid. So somehow it's interrelated, and yeah.
And how about?
Yeah, it's quite interesting the fact that you are stressing the LTV concept. And in these days, I'm negotiating a term sheet, and a private equity is asking me for a certain LTV. And but at the end, I can be ready to give him a certain loan, but then in order to serve the debt, he needs to put equity commitment. So I wonder, what's the point in pushing too much the acquisition loan if then to be able to serve the loan, you need to do an equity commitment that is like not receiving that loan. Actually, it's even more stupid because you pay interest and then you are, in any case, trapping equity because otherwise I don't give you that level of loan. So it's coming back to the basic question, do we lend to hospitality? The answer is yes. It's a matter of cash flow, yes, because the only way for you to repay me is by confirming that cash flow. And often the problem is that when I sit in front of somebody that is asking for money, I don't feel on the other side to have in front a specialized partner, but it's something that is ready to put equity in a way where I'm not ready to put debt. So if you come with a nice, sound feasibility study, and you convince me because you are the first one to be convinced, I follow you, and then the LTV is not an issue, because in any case what drives is the cash flow, and it implies a maximum LTV that in any case you will see that is roughly 50 or 60%. So the LTV should be only the resulting number of this game. And too often I have in front of me people that don't deserve my credit in Italy. Does it answer your question?
Well, it answered a question.
Because you keep on pointing at the LTV that you stupid banks, and there is the insurance, and please introduce me an insurance manager that is lending to hospitality, because I will not feel like really having in front a proper insurance manager, because I would rather invest in some other steadier industry. But all the competitors I have in these days in Italy are mezzanine lenders that maybe are less speaking covenants, but they are asking you a 10%. So it's up to you to go with an easier counterparty that is screwing you with a 10% rather than instead sitting and be patient and negotiate a covenant, and you will get the money at lower than 2%.
But as an invented statistic, do you see yourselves losing part of market share, and might be a question for Arnaud as well, to, let's call it, new entrants or different sectors that are coming to the marketplace, whether it's insurance or pension funds or debt funds? Are you perceiving that, looking over your shoulder?
In Italy, I've seen deals where the lender was, for example, Allianz, and they were too competitive, because already a few months ago they were below under 50 basis points. That for me is too aggressive, and I'm happy if insurance groups enter the market. I don't feel the competition. I mean, they are core lender. They have a different underwriting model, and I don't think that that is a problem, even because I'm ready to underwrite more complicated deals that usually insurance should not do.
The consequence meaning that you're now lending on more complex, oblique, riskier projects?
I'm ready to underwrite value-added investment. Even because in Italy, if you speak about offices, you have 1.5 million square meters vacant in Milan that nobody wants, and all the multinationals want to have grade A offices. So if you want to lend offices, you must lend value added.
Arnaud, you got any comment on lending criteria in terms of cash flow versus value?
Yeah, when we look at underwriting, basically for us the first thing is obviously the sponsor. We're sponsor driven, so being comfortable with the sponsor is the first thing. Then loan to value obviously is important, but for us we're looking at both loan to value and debt EBITDA. Debt EBITDA is a key criteria for us. So can vary depending if it's a single asset, a trophy asset, that sort of thing, region, gateway city, that sort of thing. But what we're looking as well is the business plan and the ability of the owner or the operator to deliver that business plan. And going back to the loan to value, the business plan is actually analyzed under the valuation report. And that's the reason why we're asking for a detailed valuation report, where we ask for the valuer to have an opinion on the projection which have been put together by the operator. And that on the back of that we get comfortable with the valuation and the way the loan is being sized.
What's your response then to some hotel investors that would say that they consider themselves quite entrepreneurial, are going to invest and reposition dramatically the asset? Is that something that you leave to the riskier lenders, or you'll get engaged in that conversation to understand or form an opinion yourselves about the deliverability of that cash flow? Because that's a lot of the trend that we see in the competitive market that we're in at the moment, is where core, I think I agree with Lorenzo, core is it's quite easy to lend to core and probably quite boring and dreadfully tedious to own and operate. But if you're in an asset repositioning mode, you need to, the equity needs to meet a lender that's going to understand the business plan and have the, I guess, the industrial context to put debt either from day one or draw down for capex repositioning. How comfortable are you guys in that particular situation?
Extensive capex programs, that's the sort of things that we like doing, something that we understand. We've been doing that for a long period of time. Obviously, when you look at the business plan, you look at the track record of that operator, of the owner, doing the sort of development, repositioning of the asset. You will look as well, obviously, as where the asset is located, how is compared to the other asset in the market, to make sure that the business plan can be delivered within that period of time, which has been indicated. And as you say, compared to some of the lenders, which are much more, I would say, plain vanilla, going for something more straightforward. We've got the right understanding of the asset. We are very happy to actually go under the skin of the business plan and put a structure, a financial covenant structure, which is actually following what can be expected to make sure that we properly track the risk.
Have you structured loans that include then the initial drawdown plus drawdowns for capex and then further drawdown on achievement of cash flow targets?
You mean if they increase the value at completion?
I wasn't trying to use the V word. I was deliberately focused on whether they have to achieve the cash flow thresholds that drive the release of further funds, or what are those triggers?
Well, we would certainly work maybe the other way around. Where we would say it could be both ways. It could be either we deliver more if they reach the threshold, or we have a covenant structure where if they don't deliver, we can have the sweep in place or that sort of thing. But the covenant structure would be here to actually follow what the business plan indicated initially. Any failure to the business plan with a bit of margin, obviously we don't want to penalize too quickly the owner. We would be just using what has been put under the financial documentation, finance documentation. So trigger.
Okay. So you guys look at that as well?
Yeah, what I like about value add is that it's not like a real estate that needs to keep its pace and keep its level. But value add is about like putting a lot of effort and a lot of engagement in a real estate to create value. And creating value is always something that would add value and would puts us in a comfortable situation as well. And if we really believe in the business plan, then this is a very, very nice story. And especially if we see the track record of the borrower, of the sponsor, that we believe that he really can achieve this, this can be a very, very nice story. And then, of course, we are prepared to lend capex as well, like even on a higher level. But of course, at the end, we come to the LTV test again. Mm-hmm. Of course, we want to see then that these measures somehow result in improved LTV.
But presumably, if you comfortably beat the cash flow projection, the developer does, the margin goes down, right? Because your risk is that much more covered now. Is that?
Are you negotiating a term sheet?
Well, I'm just.
Yeah, that's always the pity.
I'm asking because I'm intrigued by the idea that the more competitive core lenders or non-banking the consequence of that is not forcing, but the banks have elected to move into a more I don't use a risk word, a more business-focused and understanding means of lending. We usually have to understand that the business plan, get conviction behind it. But I mean, one of the challenges from the other side of the table that I encountered in previous years was that you got the backing of the bank, but if you over-delivered, you had to pay a prepayment penalty because you're entitled to refinance. Let's say it was a good time, and the reward for that was paying the lender that wasn't prepared to give you a discount for reducing that particular risk and exposure. So I'm interested if the banks have engaged in that kind of dialogue, because we always plan for the worst, right? Which is you're not going to miss the target, you're not going to hit the cash flow, what's my covenant, and step in. But if you knock the ball out of the park, how are you adding bells and whistles to the borrower to share that risk reduction?
Okay, can I get a word in.
I was actually bet I could ask a 4-minute question, but I don't think I got to that far.
I think it was 5 minutes, actually. Okay, so this is development funding. In very simple terms, the way this works is that you put a lump of money on day one to acquire an asset, and then you drip feed further funding over a period of time as the asset is developed or refurbished or whatever the case may be. And during the development phase, you're quite right, it carries a higher level of risk than when you get to practical completion and doors open and you start trading. So typically speaking, there's a step down in the price of the debt, so the interest margin comes down on practical completion, and then as the hotel winds up to achieve stabilised trading, so if you've negotiated cleverly with me, then there's an interest margin ratchet as the performance of the hotel improves. So I think that boxes that off for you.
Right.
Yeah. Okay.
Yep.
So thank God for that. So the next part of the question is, are we up for doing this kind of stuff? And the answer is yes. But there's a caveat around that, and the caveat is that when you do development funding or repositioning funding, is that the sad reality is it always goes wrong. It always costs more than you think it will, and it always takes longer. And invariably, when you get to doors open, the blooming asset doesn't perform quite like you would have hoped it would. And so from a lender's perspective, what I'm most interested in is that I'm dealing with a borrower who not only has the technical capability to deliver this project broadly on time and broadly to budget, whatever that means, and then operate the hotel well, but also they've got a deep pocket so that when things don't go quite according to plan, I've decided how much I want to lend, and any overrun is an equity call.
That's fair enough.
Yeah,
That's fair enough.
Thank you.
How about our current EU colleagues here? Do you have this concept of ratcheting down your risk margins if and when business plans are achieved?
From our side, of course, this is something that you would need to agree in the beginning. But on the other side, like when you are still on a riskier level, then it would be fair to have then as well a slightly higher margin. Then this would be fair again to have.
We are negotiating.
I love Landers talking about fairness. It's always a breath of fresh air. It goes both ways. I think you mentioned also that we want to understand leasing and management agreements. I'm not sure you've got your voice back yet, so I'll keep talking.
Keep going.
Until you take your hand from under my jacket. Are you able to give a distinction as to how you approach the different risk assessment on leases versus management agreements? Do you want to start? I know I'm a bit worried that the French hadn't spoken enough, which again, as a current EU colleague, is unusual.
No, we are very comfortable with lease management agreement or franchise. For us, it's all about who's part of those on each side between the owner and the operator, and the brand recognition in his market and the position of that hotel in his own market. So we can do any of those things. Then it all depends how the hotel is performing. Is he mature in his market? So that's the sort of thing we'd be looking at. Does it make more sense to have a franchise when the hotel is not really mature yet? That sort of thing. So we would be looking at all those things. But for us, it doesn't really impact. Then it's more when, because we like underwriting and at some stage we might be syndicating. So that's the sort of thing that we know that some of the lender might be looking at. So it's something that, we would be depending on the sort of people we're potentially approaching, thinking differently in terms of who approaching. But for us, in terms of risk, it's absolutely the same.
Any difference there, Lorenzo, in perception of lending risk to a lease versus owner-operator?
Okay, any bank would prefer a lease. But then what's the point in having a comfortable lease if then that lease is not paid? So it really depends on as he said, on the accountability and sound, well-analyzed cash flow. And I have, of course, with the management contract, a problem when you, hotel operator, cannot be kicked out if you don't perform. So I I'm ready to accept a management contract with a performance test where if you don't perform after a few numbers of years, I can replace you as a...
And that is an astonishing turnaround, because I think 5 or 10 years ago, the lenders would often appear to collude with the management company to put in a non-disturbance agreement to protect the asset. And it's interesting that others held a view, at least 2 of which are on this table, that actually a non-disturbance agreement might impede value or impede repositioning or restructuring of that particular asset.
I had one example, and I've suggested to the organization that it would be interesting to have a panel of a case study of failures.
Not a lot of volunteers for that panel, I don't think, but it's a good thought.
Because it will help. Avoid mistakes. So I had a nice 5-star hotel in Rome, very nice, and it was not performing. Top location, and the operator had 2 hotels in the same neighborhood. Say they didn't care, because in any case they were operator under a management contract. So there was the borrower suffering, the bank suffering, and the international hotel operator was like, okay, we are not performing well. Reputationally, we don't care because we have 2 hotels that are performing very well, and you cannot kick us out. So we took more than 3 years in kicking them out. And at the end, the hotel was sold unencumbered, so was empty.
Sorry, they had a non-disturbance agreement?
We could not kick the operator out.
Right.
And so all the investors that were ready to buy the hotel were not buying the hotel because it was with the operator inside. And so in that case, we took 3 years, and it would have been far nicer if we could say to the hotel operator, okay, can you please leave the hotel? And so when we speak about management contract, I'm ready to finance it if I have a chance, according to certain performance test, to replace the. When we speak about franchising, the hotel operator is really far. Is receiving fees, franchising fees. He has put a nice brand on it. There is some commercial effort, but what it counts in the case is the OpCo. And the OpCo, at least in Italy, the local operating company is often too weak. And so at the end, if there is a problem, the only solution I may have is to convert the franchising contract in management contract. But if it doesn't work with a franchising, seldom it can work as a management contract. So at the end, it's to come back to your question, it's a matter of cash flow solidity.
Bob, do you think that's changed, the sentiment for the lenders in the UK market?
So
that's a closed question.
The answer is yes. So, yeah, it's a closed answer for you. So, I mean, we're talking about management agreements, and the issue about lending to hotels on management agreements, as we've already rehearsed, first is when the operator doesn't do very well, you just can't kick them out. And I've never yet seen a management agreement with sufficient teeth to be able to remove an operator. That's the first point. And the second point is that with the greatest of respect to all the big multinational operators, you know, the majority of their income is driven off the top line, and so these hotels are stuffed full of cost, and so they don't convert revenue to profit and cash as well as they might. And by way of one example, one of my customers, a multi-site provincial hotel operator in the UK, they acquired 22 hotels. Which were under management to one of the major international brands, and I think within 6 months they had taken £6 million out of the cost line of these hotels because they were just stuffed full of costs. So that's the other issue around lending to hotels that are under management is, frankly, they just don't deliver as well as a hotel that's, say, under franchise agreement, where the people that you're lending money to are actually operating it themselves, and they've got as much an eye on the bottom line as the top line.
I think that's a bit of a sea change, actually, that I think that the answer would have been different between 5 and 10 years ago, that the brand was the touchstone or the lucky rabbit's foot that you clung on to when all else was failing. So it's interesting. Are you seeing that then in emerging new transactions that lenders are now agreeing with the sponsor, the borrower, not to accept NDAs?
I think on occasion it's difficult not to accept an NDA, depending upon, bluntly, just how attractive the transaction is and how much you want to do it. Sometimes you'll just compromise and accept an NDA, and much depends upon the quality of the operator, is just how well you think they're going to do for you and your customer.
Is that the same in your market, Ernst?
Yes. I mean, sometimes we believe in the operator that we want an NDA, like that we would like to have the possibility to continue with the operator because we believe in the operator.
Now, typically, would most of your borrowers be is the structure leasing or management agreement? And I've got some sort of uneducated
like in Germany,
views about Germany. That
Germany is still like this
Lease.
country, a lease-driven country. I mean, what you have to consider as well is that when you are lending to a management contract, you are lending to an operating entity. This means you are lending not to a real estate, you are lending to an operational business. And I mean, this of course makes it a bit more risky as well, just to consider that as well the market value is higher because you're valuing as well the operating entity. So a hotel with a management contract is often, like, the value is higher than with a lease where you just have the lease multiplied.
on the real estate side, rather
Yeah.
than the entire business.
Yeah, and when you have the entire business, lending the entire business, of course there's more cash available for debt service, which is positive, but on the other side there is like an operational risk as well. And of course this has to be considered as well in financing. And I guess this is as well the reason why banks in Germany still prefer a lot leases.
Lease structure. Can I just ask, again, pet interest of mine, to what extent we'll soon be a quarter way through this year versus last year, how you'll compare the pace either of transactions or lending and your perspective on that? I've got one which I will bore people with later, but I'm interested to hear how, because your activities reflect the activity in the investment market to some extent. Let's have a crack at that first.
Well, I think in the UK, we've seen over the past couple of years a lot of portfolio coming onto the market. So I think what we will see more potentially will be certainly some of those buyers of large portfolio trying to go under the skin and selling some of the assets they don't really want to keep in part of the portfolio. So I think we might see more single asset transaction in the region or small portfolio in the region coming up. So not sure we will see the same amount of investment as we've seen obviously in 2015. And then you've got on top of that the referendum adding more.
Does that cover French activity? Are you referring to mostly activity in France or?
Oh, sorry, I was speaking about the UK. Yeah. But
Okay.
in France, I think it would be the same. You would have potentially more portfolio and single asset in the region. Paris, there is 2 large assets on the market at the moment. But last year in Paris was really a busy year. So I think it will be busy, but certainly less than 2015.
Lorenzo, if you were measuring this year against last year, what's your sense about volume?
Last year we had a decent number of transactions for the five-star hotels, like Qatar bought few five-star hotels. And I think that lots of investors are looking at Italy because they believe that it's one of the top destinations for five-star, and there is a lot to be done in Italy. So I believe that they will go on looking at the five-star hotel, and it's different from UK or from France because, as you know, there are not many portfolio hotels. So it's the market that is different. Does not depend on the appetite of the banks. It's really that there are less transactions, and those few transactions will be happily financed by banks. But there are not many.
Also, how are you looking at resorts versus sort of Milan or Rome? If you're looking at high-end
we
resorts
financed last year the Forte Village transaction. That is a typical resort. We do underwrite resorts, and once again, it depends on the deal. It depends on how sound is the deal. We are ready to underwrite any possible transaction. The problem is that there are not many. I don't see for the time being any. There was a possible deal in Rome of a top 5-star. There will be soon another one, and we are ready there to fight against the foreign banks, to kick them out. We are ready, waiting for them. But the hospitality is an industry that is where banks have less appetite. Huh?
You've heard about the common market, haven't you?
Sorry?
You've heard about the common market.
The common market.
Free movement of
Yeah,
capital,
but
services, debt,
yeah,
all
but
that stuff. Okay.
we are local and provincial, so we try to fight. It's a kind of cartel of Italian banks.
Allegedly.
Openly.
Oh, yeah, open for business.
Yeah.
Not to competitors. Okay.
ING is killing us, but we are trying to fight.
Who is?
ING.
ING.
Yeah, he's the most aggressive one.
Right. Okay. As long as we're not naming names, I think we're quite safe on this panel.
Otherwise, it's too boring. Come on.
Bob, how are you feeling this year versus last year in terms of momentum and pace and energy?
Well, we got lots of energy, but the pace has gone out of it, and our pipeline of new business is somewhat thinner than it was this time last year.
Ascribed to what, do you think?
Two things. Low number of transactions. So we had a very good run from about 2011 to around halfway through last year in funding large portfolio transactions. So we had a good time. But since then, the volume of transactions has fallen off, and quite frankly, the competitive rivalry in our marketplace has intensified somewhat. Between
Bank lenders or the other people piling in?
The other people piling in.
Can I have a speech here or not? Am I allowed to?
Go for it.
Because my perception is that it's a much quieter market now versus last year. That's why I was interested whether people are feeling regionally. Not to say there's inactivity. There's a lot of. I suppose the distinction between being busy and being productive is the kind of corny one we always refer to. But there's a lot of tyre kicking. I'm not even sure they're real tyres on real cars that's happening. But shock's not a fair word. But I am moved to reflect the significant reduction of activity and sort of market momentum versus last year. And being ignorant, I don't know what to ascribe that to. But I just wondered whether I was just being paranoid in a bubble.
Are you referring to hospitality or any other
I'm referring, I'm primarily active in the hospitality market. We're seeing other sectors that are, if I look at my own business that I work for, we're seeing more activity in other sectors, for example, and hotels that has been productive, to use that word, for the last 2 years, has been noticeably slower. There were things that were closed in December, but they'd had a long lead-in time, but new stuff, I can't think of anything really significant that's kept everyone alert and excited for some time. So, if there's an expert in the audience, I'd love to have their opinion as to whether they notice that as well, whether you think we're all sitting here hanging around for June the 24th, or we've still got a bit of digestion issues, because last year was quite frenetic.
Maybe it's also for a lack of product.
Yeah, that's something that I can confirm from Germany, that like more and more real estate clients who were before active in retail, office, like the classical asset classes, they don't find any transactions anymore, and
Yeah.
therefore look at hospitality as well. Yeah, and at least there, I still see a lot of offers for us, financing offers, or at least they participate at beauty contests. I don't know what will be the outcome, but but still I see a lot of activity for hospitality in Germany.
I haven't,
Even
seen,
it's-
I haven't seen the data that normally comes out at this time of the conference season that shows what the volumes have been, but I would be surprised if we're anywhere near where we were last year at this stage in.
I don't know.
A completely unstatistical statement, actually.
I guess like last year were some portfolio transactions as well, which I guess will lack this year, but still I think there will be a lot of transactions going on. And when I look at like the pipeline of developments in Germany, that's quite tremendous.
New development.
New developments.
I keep telling you, Germans, you've got to stop building so the people that own it can make money. Every time the curve gets up really, really well.
Yeah, but there's so much money.
I met one of your
which needs to be
colleagues
invested.
from a well-known capital city not far from here who bragged that they'd given consent for 5,000 rooms to be built, and he thought that was a good thing. So obviously for existing investors, someone else's development is my new supply threat. So I'm always intrigued and surprised, well, not surprised, I'm intrigued when lenders support development, when I shouldn't do, because I'll be no doubt trying to borrow for some, in the near future. So how do you go about assessing impact of development on the market? I mean, it's a bit like feeding your enemy, isn't it?
It's all gone quiet
It's
over there.
It looks like they might just be processing that as a risk. Arno or Lorenzo, how comfortable are you in lending to new development versus renovation or repositioning or refinancing?
You mean without the urbanization risk?
I don't know what urbanization risk is.
When you still need to get the permits.
Oh, no, sorry. I meant, let's assume you've got permit, everything ready to go, but the risk that you build into the fact that you might be funding new supply risk to the market which you're building
But
into.
if you look at, it depends, it's market location by location. Because, for example, if you look at the five-star hotel market in Milan, there is still room for a few more five-star hotels. I don't think that, for example, the new Mandarin will suffer because it's in the right location. Of course, if you go and build a new resort in Sicily, you might have some problem because over there the already existing resorts are not doing particularly well. So it really depends on what we are talking about. No, I do not have in principle problems with the new development.
Interesting. Okay.
But as a matter of fact, then we do finance a few developments because a few projects passed the exam and the analysis. Mm-hmm. But that does not depend on the fact that it's a development. It depends on the fact that it was a wrong project. But not because it's a development.
I mean, Germany is as well like a bit of special markets compared to UK. When you look at the big number of still private hotels which are in the market in the big cities, where you don't know if they will continue with the operation when if it will still stay in the family. So I think there will be still potential for substitution of these hotels. And as well, I mean, the demand is still growing. But of course, as well, I mean, we see some red lights as well because there are quite a huge figure of new developments. And I mean, what we try is to be at the right location to somehow be then the ones who are in the right location with the right product.
Bob, you do much development lending?
Yeah,
New build?
we're quite picky and choosy about it for all the reasons that I articulated previously about time and cost overruns and so on and so forth. But nonetheless, we do have an appetite to provide new build funding, but it all relates around inevitably location. So, if you want to build a new hotel in, say, London, for argument's sake, London has this ability to absorb just continuing increases in hotel supply, albeit sometimes there's a massive influx of supply in certain segments of the market. We'll see a softening of their performance as a result. But would I do something in London? Absolutely. In the northeast of England, would I want to fund a new hotel development in a place called Liverpool? No, not really.
That's because it's northwest, Bob.
Yes, you're quite right. It is northwest. I
That's
should
why it
have
might
done
be a bad
geography at
place to
school. I
start.
beg your pardon. Thanks for making me look so stupid. Thank you. Yeah. So would I do something in Liverpool? No, because it's over-hotelled. Would I do something in a provincial city called Cambridge? Yes. You know, if someone could get a permit to build a hotel in Cambridge, I'd fund one there all day long, because it's a very strong market with, you know, remarkably high barriers to entry. So it's all about local knowledge of about a particular area.
Excellent. So I think we've got a couple of minutes left, but yeah, attempt at a wrap-up statement, just given the voices falling apart. But you know, I'd be interested to hear, and I think just to sort of provide some perspective as well. You know, we focus entirely on hotels, but when you're looking at hotel spreads, what's the percentage difference when you look at a core hotel spread versus just a core office spread in the same market? So if you take London versus Milan versus Paris, is there a difference? Is it the same? Is the bank looking, you know, to get a premium given the asset class and the operating risk? So I'd be curious to see how, you know, what is the delta? And again, it sort of provides a bit of a framework and perspective, given that I think, you know, 9 out of every 10 assets that are traded in Europe tend to be on the office side versus hotel or other asset classes.
Well, I mean, for us, obviously there's a premium for hotel. The reason why is just you use more capital. For you know, in our system, it's more capital consuming. It's an operating business. You're not going for 20 years leases with rent uplift only. So obviously there is a premium for that. Now the gap between how much you would charge for a 50% loan to value real estate and a 50% loan to value hotel really depends of who's your sponsor, your location, all those things. So I can't give you a figure, but there is a premium for us, definitely.
Yeah, see. Yeah, for the hotel sector, you have a premium that depends on the riskier business than a simple office core asset. Yeah, of course, it's not possible to give a figure because it really depends on the specific hotel.
Excellent. Well, seems there's a premium, but no one's willing to divulge in terms of what the you know, percent difference is. But I think look,
I think Norton a lot was the general indication. Was that?
Yeah, I think generally speaking, what we're seeing is roughly about a, call it 20 to 50 basis point pickup on spread relative to the core side. Again, sort of if you take core office and gateway cities versus however you want to define core for a hospitality asset, that's sort of the spread differential that you're seeing across the board. And then I think to the point that the guys made, it's really just a function of, you know, what the actual EBITDA to debt multiple is, so the cash flow, which will vary between whether it's, you know, transitional, trophy, et cetera. And I think that spread premium actually widens out the sort of higher up the, call it, cash flow risk curve you go, i.e. there's more sort of disruption or something that needs to happen at the asset level. So at least from our end, that's certainly something that we're seeing. I think with that said, you know, thank you to all the panelists for taking the time today and enlightening us with sometimes quite a lot of detail around who's being pretty competitive and whatnot. But I think you know, it was hopefully instructive and informative, if anything. So thank you.